So first of all, the idea that money printing causes inflation is just not true. Now, everyone believes it's true. The monetarists, the Milton Friedman followers, the Austrian economists, even the neo-Keynesians say, yeah, if you print a lot of money, you get inflation. It's not true. And just for empirical evidence, I don't just say things like this without backing them up. Between 2008 and 2015, when they ended, 2014, when they ended QE3 at the time, the Fed expanded its balance sheet by almost $3 trillion. And we never had inflation. We never had serious inflation. You get 1.5%, but we never had serious inflation. The whole time the Fed had a target. This is 11 years if you want to go all the way to the end of the expansion in 2019. Technically February 2020, 11 years, and the Fed never hit their target of 2%. A couple months, yeah, but not on a sustained basis, and certainly nothing above that. So I like to say it's a sad day when the Fed wants inflation and can't get it, and they do want it. So now they've come up with a new monetary policy. They've sort of, as I say, given up on the money printing thing. They say, we're just going to let the economy run hot. We're not going to worry about, money supply as much. We're just going to, basically let unemployment drop, hopefully, and let inflation go. And if it goes above 2%, we're going to let it stay there for a while. So the below 2% and the above 2% kind of average out to 2%. That's new. Here's the problem. You can say it. You can take a vote and make that your policy. It doesn't mean you can make it happen. They failed for 12 years or 11 years. Why do we think they're going to succeed now? The greatest danger in the macroeconomy today is deflation because of declining labor force participation, declining productivity, and most of all, velocity. But velocity, as I just described it, is a psychological phenomenon. How do you feel? Do you feel prosperous? Do you feel confident? Do you want to go out and buy dinners on me or drinks on me or whatever, buy a new car set? Or do you feel cautious? Do you feel concerned? You saw your neighbor lose her job, you're worried about losing your job, etc. So you save more. Well, the evidence is people are saving more. We're in a liquidity trap. Saving was sort of kind of working its way up from 5% to 8%. In April, it was 33%. In May, it was still 25%. In June, it was 17%. So savings can be a good thing, but in the long run, if you have productive investments, and that's a big question, but in the short run, the savings come out of consumption. If I make money, I'm either going to save it or spend it. Well, if I save more, I'm spending less. So all the signs point to deflation. The Fed can say they want inflation, and they can print all the money they want. Doesn't mean they're going to get it.
Is it safe to say you're more worried today than you were then, or even say a year ago?
No, a year ago, I was saying that the economy was weak. I mean, my last book, Aftermath, came out in July 2019. So it's just a little over a year old. It's not like I wrote it 5 years ago. That book's a little over a year old. Go look at page 288 to 291. I talked about pandemic. I said 100% chance I had two other scenarios. So 100% chance one of them happens in the next 3 years, and pandemic was on the list. So, and I also talked about civil unrest and armed militias in the streets, which we're seeing every night. So everything that's happening now, I forecast in my book, Aftermath, which came out in July 2019. You can just go look it up. So my new book, The New Great Depression, is going to take the story forward and tell you what's going to happen in the next couple of years. But the deflation story is not new, Danielle. It's been persistent, and it's getting worse. The Fed does. I could tell you how to cause inflation in 15 minutes, but unfortunately, the Fed kind of forgot how to do it.
You mentioned gold before, Jim, and a lot of investors are concerned with the metal because we're seeing these ebbs and flows, this volatility with the metal. But I want to bring up one tweet you recently tweeted, and I'm just going to read it here. You say, reminder, when stocks tank, gold goes down as leveraged players sell gold for cash to meet margin calls on stock losses and other liquid positions. Once it's down enough, the strong hands pounce and gold rallies again. So I think that's a really interesting point, and I think a lot of people forget this is a similar pattern we saw in 2008. Tell us more about this, Jim.
Sure. I like to say there are two kinds of buyers of gold or investors in gold. Generally the strong hands, the strong hands and the weak hands. The strong hands don't use a lot of leverage. They use cash or capital. They're in it for the long haul. They're not day traders. I watch the tape because I'm an analyst, and I do a lot of interviews about it, and I write about it. But I'm not a day trader. I don't get too euphoric if gold goes up. I don't get depressed if it goes down. I know where it's going in the long run. It's going to the kind of neighborhood of $15,000 an ounce. But that doesn't have to happen next year, even the year after. If that's the trend, then I like to remind people, if it's going to $15,000 an ounce, which it is, it's got to go to 3,000, 4,000, 5,000, 6,000 along the way. So that's the long-term trend. So I don't worry too much about the wiggles. But yeah, as far as the stock market is concerned, and this happened, you're right, it did happen in 2008. I remember the worst part of it in 2008, and when the stock market was absolutely crashing, gold was going down, and I was getting all these calls. Hey, Jim, gold's safe haven, how come it's going down? Well, what happens is, in a liquidity crisis, everybody sells everything. Especially the weekends. If you're leveraged and you're in the gold futures market and you're long and the market's collapsing, you got to sell. You got to get out. You got to cut your losses. So what people do is they sell gold to get cash to meet the margin call on the stock losses, or they're on the wrong side of the gold market and they're leveraged and they just sell to cut the losses. So it does go down. It's highly predictable, but strong hands are waiting. It's like if you've ever seen a lynx or a mountain lion hunt, they don't stalk their prey, they just wait. They sit there and wait, and then they pounce. Strong hands are watching, they don't jump in on day one, they wait till it goes down enough, and then they come in and buy, and it goes right back up again.
So would you put Buffett in that category?
Well, Buffett's a little different. I think he did buy big stake in Barrick Gold Mining recently. I think he's more of a fundamental. He's not a market timer, certainly. I don't think he's much of a technical analyst. He is a fundamental analyst, but he saw something. Yeah, I would put Buffett in the category of strong hands, but Buffett wasn't around. He was around, but he wasn't buying gold in 2008. He wasn't buying it in 2015 when the stock market went down sharply. But if you again look at every one of these instances, Danielle, you'll see that the immediate reaction gold was down, and it finds its footing, and then it goes straight back up again. I fully expect that to happen again. An interesting thing about the United States, the U.S. gold supply went from about 20,000 tons in 1950 to 9,000 tons in 1970. Then there was a run on the gold bank. It dropped even further. That's when Nixon shut the gold window in 1981. But the U.S. still dumped gold alongside the IMF between 1971 and 1980. But 1980, we just stopped cold. The U.S. gold supply today is almost exactly what it was in 1980. But what we, the United States, did is we got everyone else to do our dirty work. So what does that mean? The UK sold over half their gold in the late 90s. The Swiss National Bank sold 1,000 tons in the early 2000s. Canada sold all their gold. You and I have more gold than Canada because Canada has zero. If you have one coin, you have more gold than Canada, et cetera. So, and the IMF sold 400 tons in 2010. So the U.S. didn't sell any more gold after 1980, but we were getting everyone else, again, Canada, Switzerland, UK, IMF, and others to sell their gold. Finally, they said stop also. There was almost a referendum to stop this happening legally in Switzerland and so forth. So everyone else stopped selling gold. So now you have one group of central banks who are buyers, another group of central banks who are just sitting tight. So that increases demand. Supply is flattish. If you look at global mining output, it's been pretty flat for about 5 years. And we talk to miners and people very close to the ground. They say it's obviously going to go down in 2020, partly because of COVID. Because mines are like any other business. If you have a pandemic, you have to shut it down. So supply's going down, demand's going up. I don't have to tell you what that does to price.